In this series, I'm going to go through the foundation of what a lender looks at when he's pre-approving a mortgage application. Now, they immediately become a CIA agent in that they're going to look at your credit, income, and assets. Now, the days of stated income loans are mostly over, while there are exceptions to that, but just your standard conventional FHA, VA kind of loans, you do need to provide documentation. The documentation is really important because that's what the lender is going to really base numbers off of, even though they can get a feel for what your scenario is just over the phone with the verbal information that they give you. Now, there's going to be requirements for each of those individual credit, income, and asset criteria, but they're also going to be looked at together as a whole. And they're looked at through a program called Desktop Underwriter, which is an automated underwriting system that's used for conventional FHA and VA loans. So even if you do hit all the minimums, say you have just enough income, your credit score is just above what the minimum is allowed, you have enough assets, you can meet all the minimums, but if you don't have a high enough score for overall risk through Desktop Underwriter or DU, then you may not be approved. Now, it doesn't end there because there's lots of different loan programs, and there's also a way to sometimes manually underwrite a loan. Now, you as a borrower don't need to worry about any of this because this is what your loan officer is doing in the background. But these are the steps that he's taking. He's looking at those 3 items, and he's going to run it through an automated underwriting system. Next, I'm going to go through each of those in a little bit more detail.